Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you on Wednesday, March the 2nd. The year's 2022. Let's talk trading. Trading better. These videos are for educational purposes only. Your results may differ from mine. Trading better. Well, if you're like most traders, what you think trading better would look like is when you enter, price goes in your direction and you get to exit for a nice profit and you don't leave too much on the table. But you see, if you spend all your time focusing on that, you're going to get disappointed, and you might wind up like a irrational or unreasonable adolescent because you'll throw a fit, want to throw your computer screen or monitor or laptop or phone at the wall or stomp on it and smash it, because sooner or later you're going to have a trade that doesn't go your way, and it potentially takes back a lot of profit that you've earned, or it's actually eaten into some of your original stake. Of course, I put this screen up about risk management, and it's a couple of really simple equations. You determine what your risk is, how much you're willing to lose per trade, and then you determine where your stop loss is, and then you calculate your position size, or you determine your position size, calculate your stop loss, or you use some other formulas. In fact, a couple indicators I'm working on are different formulas to calculate where your stop loss should be based on your risk. One of them is an ATR stop, and another one is that Kelly formula or criteria. But the thing about it is, most traders don't focus on that. It's like, no, 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 let's find the best entry. Hey, and you know what? I'm guilty of it too. In fact, the whole thing with the EMA 5, that was part of it, where I was wanting to just get some better entries, because you're doing the lower high, higher low box. Sometimes price will move against you. So I was just looking to see if maybe there was just a little bit slight edge using the EMA 5 to help time it. And there is a slight edge, and trading along with it. In fact, this morning, I got into a trade and it went against me, and I took another trade and that one went against me, and then I had to take a third trade, and then I started trading my way out of the mess. But the trick was, and it's not that I was a great trader, it's just that I kept taking the signals when they presented themselves. Because like that, unruly teenager, if something doesn't go their way, they sit there and they pout and they quit. You got to get in the game. You got to stay in that game. Or you could just sit on your hands and hope that price comes back. And in fact, from the original trade, price came back and even went up another 11 or 12 pips. But I had punched out way sooner, uh, because I was looking at a nice 2% profit on the overall account, and I didn't want to give that back. And then I decided to leave well enough alone and not push my luck. So the bottom line is, trading better, there's a few components. And probably a really important component is what you do when things aren't going your way. And because, see, part of that is risk management, of course, but I think what I'm probably going to talk about next, and that's the brain management. You know, we've all experienced that FOMO or FOLO or ROMO or ROGO or ROBS. sometimes a couple of them all at once. And the thing is, it's because we don't have our brain management in place. You know, and I think I might have mentioned before, a lot of times we're not trading what we see on the chart. We're trading our emotions. Meaning, you see price going your way and you start cheering it on like it's a racehorse. It's like, go, go, go. I mean, I do it. I admit to it. As opposed to just sitting there thinking, okay, if it reaches this point or these other gauges tell me, hey, you know what, this thing's probably run its course for now, maybe I should punch out. Because that happens a lot. In fact, here we've got the indicator too. I can show you. I think it was on M5. Yeah, right here. This is a perfect example. You see how price was making lower lows, and then we had this inside bar. We broke the low and the high. I was looking to go long. I jumped in, price ran up. And then as soon as this turned a little bit negative, I punched out. And you see it came all the way back down here, which actually gave me a chance to get back in, but I said, nope, that was it. But, you know, the reality is you stay in the trade until it crosses below the dots. And you can see between here and the dots, 4.9 pips. But had I stayed in the trade, and even if it were to get out there, I would probably have another, 7 or 8 pips. So I wasn't managing what I saw on the chart. Now, I was managing one emotion because I was glad to get out. And I was also managing, you know, the overall money, thinking, okay, that's enough. But you can see here, it definitely paid off. And even if you come down to the 1 minute chart, you can see, once again, you know, you try and follow those dots. You come off a low, you get in, and, you know, it's almost the same setup here. Here, you just wait. And it's almost like if you can sit on your hands and after, you know, 3 or more of these magenta dots, just sit on your hands and wait, which is something that's hard to do for some of us. I'm talking about myself once again. Just sit on your hands and wait. Then you can get in, and then you probably may not experience much of a drawdown. Of course, you know, these videos are educational purposes only, and anything can happen. But when you look back, you know, if you do a hairy hindsight, it's all kind of crystal clear. And the other thing, though, sometimes to look at is, because today we've had some kind of anomalies, but a lot of times you want to see price, you know, start the range and then look for it to break out. In fact, you know, I think this might have been the trade that I took. Yeah, I think this was the trade, not this trade here. But you see, it came up somewhere along here. I think it was this candle. It started to go against me, and I just punched out and said, fine. And then it came back, and I had a chance to re-enter here. And you can see here, you close. This candle closes. This is where that dot appeared, or diamond, the indicator 2 diamond. And that gave me a chance to re-enter, but I didn't. Why? Because it wasn't my trade number 1. And that's something else. If you want to trade better, even though you see an opportunity, you have to define, is that my trade? And a lot of times what will happen is especially if you get in a trade and it goes against you and you want to try and trade your way out of it by adding to that position in the same direction. You'll start to airball trades. You'll start to see things that you should have been paying attention to, or you shouldn't, or you forgot to pay attention to. You'll start to see these things, and then you go, "Oh, I wish I hadn't have done that." For example, price was right near the daily open, right below it, and I went long, and it reversed on me, and I was like kicking myself because on my screen I had my price near indicator. Let's see, I don't know if I have it, but similar to this one. But it's telling me, hey, you're close to the open. In fact, let's see. I think, and here's the indicator right here, close minus open. I can see how close I am to the opens, and this one was red at the time. But look at it now, it's at 54. Had I stuck with that trade, well, I'd be up 54 pips from the open. But then again, that's hairy hindsight. But that open was 55 pips ago, which, what was the daily open on this platform? 17. So right about here, you can see what price was doing right around that daily open. And if you look left, it went up, it bounced off of it, went up, came all the way back down to that daily open, and then rocketed. So you want to trade better than, if daily open is one of the trades that you trade, and you put that on your chart, you pay attention to it, and you trade accordingly. Price crosses above, you go long. Price crosses below, you go short. You put your stop loss in. And then, if you want to use indicator 2 to stay in, or some other thing, you want to do higher lows to stay in, you just pick your method. So, I mean, here, it was making higher lows, higher lows, higher low. It made a lower low, but it closed above the dot. You stay in, higher low, higher low, higher low. It came and actually closed below that low. So maybe right here is where you punched out. And I don't think you'd be mad giving back. Well, yeah, you might be mad giving back 9 pips. But then again, you just don't know what's going to happen. So, or maybe since it broke that highest low here, maybe you punched out here and only gave back 4 or 5 pips. But this is the tough one right here. When it shoots up and comes all the way back down, that's the hard one right there. But you have to decide how you want to handle those. You can have your exit playbook. You can say, well, hey, you know what? This is more than 5 pips away from the open, and it's, that only happens 16.8% of the time. So when that candle closes, you exit the trade. And you can see here, it happened again here. If you exited that trade, you actually had a chance. If you wanted to stay in, you could have gotten back in at a lower price and made even more pips on the way up. So, fellow traders, those are just a few things to think about to trade better. And maybe you can answer the question. Let me know what trading better would look like to you. Is it something you do before the trade, during the trade, or after the trade? Because always remember and never forget, it's not what you trade, it's how you trade it. So go out there and drain the banks. And this is TheRumpledOne. Over and out.